Most nonprofits survive or fail based on one thing: contributions. What looks simple on the surface is often where organizations get into the most troubles with donors, auditors, and the IRS. Welcome to Joe Talks Nonprofits. I'm Joe Blatt. After 40 years working exclusively with nonprofit organizations, I can tell you this with confidence: contributions cause more confusion than almost any other revenue stream. Today's episode is designed for board members, CFOs, CEOs, and nonprofit professionals who want to understand not just what a contribution is, but how to account for it properly, how to honor donor intent, and how to stay out of trouble. During this session, we're going to demystify contributions, including restrictions, conditions, fundraising events, endowments, and donor advised funds. We're going to do this using real world examples I've seen over the years. We're going to leave non-cash contributions for another episode. Nonprofit organizations generally have three main sources of revenue: program revenue or earned revenue, such as tuition, fees, and membership dues; investment income, generally from surplus cash, investments, or endowment funds; and contributions. But here's the truth: program revenue rarely covers the full cost of operations. Most nonprofit organizations ultimately succeed or fail based on their ability to raise and properly manage contributions. And that's where things get complicated, because not all contributions are created equal. The most common and simplest contribution is the unrestricted donation. These contributions have no restrictions, no conditions, and the organizations can use them to fund their operating mission. The problem arises when donors or grantors get specific. Also, many fundraisers find it easier to solicit contributions to support a specific purpose or a cause, for example, financial aid, a capital project, or new equipment. When this happens, the organization has a fiduciary responsibility to track and use these funds exactly as intended. Let's give you a few real-world examples. Let's say an organization raises $40,000 to purchase a $25,000 3D printer. Sounds like a good problem, right? Until you realize these excess funds are now restricted and may sit unused for years until we need a second or a new printer. Or the opposite could happen. An organization raises $50,000 towards a $200,000 project. Now leadership is forced to cover the difference from operating funds. In addition, I've seen organizations so focused on fundraising for a specific project that they don't raise enough money to cover their unrestricted needs and their administrative costs. The lesson here: specific solicitations create accounting and governance consequences. It should be one tool to raise funds, but not the only one. This is why I generally recommend leaving room for flexibility in our solicitations. Instead of asking for a 3D printer, ask for equipment and technology for the arts department, including a new 3D printer. Instead of launching a capital campaign without certain commitments, secure lead gifts first. Good fundraising language protects both the organization and our donor relationships. An endowment is another type of restricted contribution. An endowment's a pool of donated funds invested to provide long-term support for a designated purpose, such as financial aid or program sustainability. Endowments are governed by UPMIFA, Uniform Prudent Management of Institutional Funds Act, which requires nonprofits to spend prudently, preserve purchasing power, diversify their investment portfolio, and most importantly, follow the donor's intent. Most organizations adopt at the 3 to 5% spending rate designed to balance current needs with long-term sustainability. This means they use 3 to 5% of the average balance of the portfolio for the endowment's intended purpose. So for example, if you have $1 million endowment, you would spend between $30,000 to $50,000 a year on the endowment's intended purpose, for example, financial aid. Endowment funds carry serious fiduciary responsibilities. Even if an organization closes, endowment funds need to be transferred to a similar mission-based organization. There are a lot of complexities here, so devote the next episode specifically to endowments. Now let's talk about fundraising events, dinners, galas, bake sales, luncheons. Those are not pure contributions because they involve reciprocity. The donor receives something of value in return for their payment. This is known as a quid quo pro transaction, or in English, this for that. If a donor pays $1,000 to attend a gala and receives a dinner worth $250, only $750 of their payment is tax deductible. The nonprofit's required to determine that fair value, to disclose the non-deductible portion of that payment to the donor, and to report the event within their IRS Form 990. As a reminder, the fair value is what the donor receives, not what the organization pays. Determining fair value is not always easy and requires some work on the part of management. I have seen management get complacent in this area and not update the fair value of their events, even when venues change and costs go up. It's important to document how you came up with that fair value so you don't have a problem with the IRS. Remember, there's an incentive on the nonprofit side to keep the number low, to give the donor a higher tax deduction, and the IRS knows this. I frequently get asked, what if the venue hall and food is donated? Does this change the deductible portion on the ticket? And the answer is no. You have two distinct events to account for. First, you have a donation of the event space and the food. The donor who's giving us the space gets a deduction for the cost of those items. Separately, we have a ticket sale. The donor here gets the value in excess of fair value as a deduction. There are certain exceptions to the quid quo pro rules when there are token gifts or logoed items. It's a lot on public television when they offer you tote bags with your donation of a minimum dollar amount. We're not going to go through those type of items today, but know they do exist. Many nonprofit organizations also conduct raffles either at their fundraising events or on their own as an additional source of revenue. Few words of caution here. Raffles are a form of gambling, so the purchase of raffle tickets are never tax deductible. Also, since this is a form of gambling, most states have some form of legislation and regulations requiring registration depending on the size of the event. Also, similar to other gambling events, the organization has an obligation to issue a 1099 to the winners if the prize exceeds a certain threshold. So please be careful when conducting raffles. Let's talk about when to recognize a contribution. This is one of the most misunderstood areas. A contribution is recognized when there's a clear commitment from the donor. Pledge for $100,000 over 10 years, that's recordable. A statement like I'm thinking about giving, that's not. Now let's complicate it. If the donor promises funds only if certain conditions are met, such as matching funds, that contribution is conditional and shouldn't be recognized until those conditions are met. The key indicators to look for in these type of transactions is a measurable barrier. That's the proverbial if. And a right of return, or in some cases, the payments will not be made until the barrier is satisfied. When a nonprofit receives a pledge, they need to consider the present value of the future payments, as well as the probability of collections in determining their value. A payment of $10,000 in 10 years is not equal to a payment of $10,000 immediately. Also, remember the definition of a contribution. It's a non-reciprocal transfer of cash or other assets to the organization, where the donor does not receive anything in return. In addition, it needs to be given from a person's free will. So if a school says you must make a contribution of $5,000 as part of your tuition, or a membership agreement to a club say you must make a contribution of $5,000 to the club, the IRS considers these as payments for services and not contributions. So be careful, wording does matter. Remember, restrictions limit how or when funds are used. Conditions determine whether funds are earned at all. Restricted contributions will have a time restriction or a purpose restriction or both. However, restrictions must give the nonprofit organization some level of variance power over the use of these funds in order for it to be recognized as a contribution, meaning they need to have some discretion within the donor's intent. If the nonprofit has no discretion, for example, directing funds for a specific individual, it may be acting as an agent and not the true recipient of those dollars. The key question is always, does the nonprofit still have control within the donor's intent? Let's go through a few examples. If a donor gives your organization a contribution restricted to financial aid for eligible students, this is a restriction. If the same donor gives you a contribution restricted to pay the financial aid for a specific student, then you're acting as an agent, and this is an agency transaction, and it's not considered to be a donation. You are strictly acting as a conduit to pass along these funds. Therefore, you have no variance power. If the donor says, if you establish an endowment fund for financial aid, I will give you $10,000, then the if makes it conditional. And until you establish the endowment fund, you don't have a contribution. As a member of management, one takeaway, you should always be careful with the ifs. Before saying yes and accepting a contribution, you are making a commitment that may be more expensive in the long run than what you can afford today. For example, if you get a contribution to build a pool for your local Y, once you say yes and build it, who will pay the maintenance? Is this something that's in your budget? If not, you need to figure out where those funds are going to come from. Next area we want to talk a little bit about are donor advised funds. Donor advised funds, or DAFs, are becoming increasingly popular and are frequently misunderstood. A person can establish a donor advised fund by making a donation to certain types of nonprofit organizations that maintain these funds and let the donors recommend to where these funds ultimately will get granted. The nonprofit will generally receive a fee for these services. As a result, the donor will get a tax deduction at the time the funds are transferred to the DAF and not have to wait until they decide which nonprofit will ultimately get the recommendation for these funds. A few things to note. Donors cannot make a pledge out of a DAF since they can only recommend where the funds go and don't control it. Donors can't restrict DAF grants. However, the DAF itself can restrict that. And donors can't pay for quid pro quo transactions using DAF funds. They cannot buy gala tickets, auction items, or anything that has an exchange component. Remember, the donor already received a full deduction when they made the contribution to the DAF. They also can't bifurcate the transaction and offer to pay for the tax deductible component of the event from the DAF. This is not allowed by the IRS. If a donor pressures your organization to accept the DAF payment improperly, don't do it. The risk is not worth it. In addition, as these are donor advised funds, the donor can only suggest to which nonprofit these funds are going to go. It's ultimately the responsibility of the nonprofit to make sure that it aligns with their mission. I have seen DAFs reject requests for donors in certain circumstances. Nonprofits have clear obligations to issue tax receipts to donors within certain thresholds. $250 for outright contributions and $75 for quid pro quo transactions. Receipts should include the donor's name, the date, and the amount, and also disclosure of any goods or services were received by the donor. I would recommend sending thank you letters to all donors, regardless of the dollar amount. This is not just compliance, it's also good stewardship. As we discussed earlier, quid pro quo transactions can be complicated. Not reporting the non-deductible component to the donors can be costly, both with IRS penalties as well as donor relations. Making sure we are in compliance is essential. It is so important to the IRS that this question is included in the IRS Form 990 and asked of management on an annual basis. I would be remiss if I didn't add a bit of caution here in soliciting contributions. The IRS determines if an organization is a charitable organization on a federal level, but each state has its own registration and filing requirements to solicit contributions or do business in their state. So if you decide to expand your footprint and either hire employees, open an office, or actively solicit contributions in a new state, you need to register and follow that state's requirements. So do your homework before venturing into new territory. Some states' requirements are more onerous than others. As I mentioned earlier, I intentionally skipped over non-cash contributions and volunteer services in this session, but I will devote sessions to these topics in later episodes. They are important and deserve their own episodes. At the end of the day, contributions aren't just about generosity. They're about trust, accountability, and stewardship. Whether you're a board member, a CFO, or a nonprofit leader, understanding how contributions work protects your organization, honors donor intent, and keeps you out of trouble with the auditors and the IRS. Getting this right isn't optional. It's fundamental to good governance and long-term sustainability. If you found this discussion helpful, subscribe to Joe Talks Nonprofits, share this episode with someone on your board or finance team, and join me in future episodes where we'll go deeper into topics like endowments and non-cash contributions. Before we wrap up, I want to recognize one of our sponsors, Forbes Mazars, a top 10 accounting and advisory firm with a strong global presence. And on a personal note, I recently retired from the firm as a partner, so this one is especially meaningful to me. This podcast is intended for informational and educational purposes only and does not constitute legal, accounting, tax, or other professional advice. Listeners should consult with their professional advisors regarding their specific circumstances. Thank you, and I hope you'll join us in future podcasts.